Well, good morning and welcome to a Friday. I might call it a coffee discussion this morning. And we have with us today Mick McAteer from the Financial Inclusion Center. And we're going to have a great discussion, I think, about the role of financial services. And we've entitled this Getting Back Its Mojo, Uncertain Times for UK Financial Services. And Morgan, who's put the slides together, couldn't resist. Keep calm. You'll get your mojo back as a cover slide. You'll know me. I'm Michael Mainelli. I'm the executive chairman of CN. And it really is my delight to be able to introduce and chair some of these fascinating webinars that we're holding. It's only, though, thanks to our sponsors. We have a wide range of sponsors who are extremely generous and allow us to go across the field of technology, economics, and finance, often with social purpose, and range widely where we wish. So thank you very much to our sponsors. Today's agenda is fairly straightforward. My job is to get out of the way and let Mick have a few words, and then we're going to have a discussion. And it's very much a discussion because we're going to be looking at several decades of work that Mick has put in trying to increase financial inclusion in the United Kingdom. And I feel that this is a topic worthy of revisiting. In preparing for today, I went over the history of the financial inclusion efforts over the years, and there has been progress. It's not all bad news. There's a bit of positive news we'll come to, but it is achingly slow progress. So Mick will be discussing with me on four broad themes, and then we'll turn to Q&A from the audience. So please do use the GoToWebinar chat facility to send through any questions or comments. This is one of those sessions where I feel comments are likely to be just as important. Now, Mick's biography is on the website. There's also links there to all of, well, not to all, to the Financial Inclusion Center, and a selection of 5 of his blogs on many of the topics we're going to cover today. So do feel free to go there and check it out. And you'll have seen in the chat room, the slides are up on the website as well and available to you. And the recording, as ever, will be posted in a few days. So that's it. Now, Mick, over to you. So the first thing I just thought was to give the audience, we'll come back to this slide at the end, but just to give the audience a feel for the breadth of issues that you see at the Financial Inclusion Center handling. Would you like to comment on this slide?
Yeah, sure, Michael. And let me start by saying thank you very much for the opportunity to take part in this discussion. It's a real pleasure. I'm well known as a consumer campaigner, but I hope I'm known as also as a critical friend of the financial sector. This is not about sort of killing off the city of London or whatever. It's about making the city work better for the real economy. So I hope who's ever watching or listening in takes what I say in that train of thought. So I hope it is a constructive dialogue, and I definitely look forward to some questions later on from the audience. But to your point about this slide, just to give you a sort of a feel for what we're working on at the moment at the Inclusion Centre. The first thing there is about what we call new model financial regulation, and I think it isn't just consumer campaigners. I think a lot of the industry would actually agree that that post Brexit, there's actually a good opportunity to develop a sort of a tailored financial regulatory system for the UK now that we have the opportunity of Brexit. A lot of the European regulation wasn't always suited to UK domestic finance. However, I would say that a lot of good stuff did come out of Europe. So I would never knock membership of Europe, but I think there's a real opportunity here to make regulation more responsive to emerging scandals. Because one of the big criticisms of the FCA, and I speak as a former FCA board member, was that the regulator was too slow to respond to emerging scandals. But in defence of the FCA, that's as much to do with the legislative regime rather than the approach to regulation adopted by the FCA. Nevertheless, that's history. We now have an opportunity to develop, I think, a more responsive, flexible regulatory regime once Brexit is actually done. The second thing we're looking at here is what we call the post-COVID bridging scheme. I think it's pretty evident, and I haven't met anybody who disagrees with me, that actually we're about to face some horrific unemployment figures as a result of the COVID pandemic. Now, we're not labour market economists. We care about financial inclusion and access to credit and access to banking and so on. We think it's going to be inexorable that millions of people are going to find it harder to actually get access to affordable credit in the future because of the pandemic. So we're arguing that really we need some kind of bridging scheme to actually get people from the difficult position they're in now back to a position almost of financial rehabilitation. But we do need some kind of bridge scheme that helps them through that. And that is going to involve, by definition, a sharing of the burden between the government, the lenders, and households themselves. So we're working on how you actually develop a bridging scheme that actually manages our way out of the crisis, basically. On the universal service obligation, Michael, yeah, I know we've had conversations with this before. This is really interesting for us because I have to say, and this is an admission of failure on our part as well, as inclusion campaigners. I have to say we have made almost no progress on financial inclusion in the UK. I think there's one exception, and that's when it comes to access to basic bank accounts. Even now there's still over 1 million people without a bank account, but the numbers without bank accounts have really come down significantly because of a concerted effort to actually tackle that particular problem. And I should say there was a threat, and because of a piece of European legislation where people now have a legal right of access to a basic bank account, that really did focus the minds of the banks as well. So, but that is the one area where we have made progress on financial inclusion in the UK. And just to give you an example, there are still 7.5 million households in this country without even basic contents insurance. That is, I think, it's a scandal. There's something like 266 billion worth of possessions that are uninsured. And those possessions could be insured for about £56 a year. And the market has not found a way to actually provide low value insurance to those underserved, hard to reach households. We would argue really that if that's the case, that the market can't deliver, then there's a real case now to be made for some form of universal service obligation for insurance, because it really is one of those critical financial products that people should have. The next issue really is what we call citizens shared prosperity funds. Now, I think this is really interesting because what we've noticed over the years is that a lot of our primary markets are well-known markets like the London Stock Exchange, the FTSE 100 index and stuff like that. A lot of that financial activity is increasingly detached from real economy activity. And the market is plagued with short-termism. We have one of the lowest expenditures on research and development in the European Union or in the European countries. And I think what's happening now is that increasingly ordinary people, ordinary citizens, ordinary savers are really being excluded from sharing in the future prosperity of the country because of the functioning of our primary financial markets. So we're looking at new ways of actually trying to develop long-term investment funds that would allow people to share in the growth of the economy and the prosperity of the economy without any of the disadvantages of the old. People will remember the old style with profits funds or whatever, which were a great concept, but which were plagued with serious problems around accessibility and high charges and transfer values. So I think there's a real merit there in trying to look at a way of helping ordinary citizens share in prosperity. And then the last thing that we're working on really is a post-COVID thing again. We think this country is going to need significant amounts of resource or capital put into things like social housing, regeneration, rebuilding the social infrastructure. And so we're looking at ways of trying to create new investment vehicles to channel long-term finance into sort of rebuilding and regeneration of the economy post-COVID. So those are the big things we're working on amongst many other, but that's a flavour of what we're doing.
Well, Mick, that's great. And as I said, we'll come back to that slide at the end. So thank you so much for setting this stall out so clearly and succinctly. Just a couple of things. I was doing a bit of background on this use of the word mojo, which is apparently a Gullah word, Creole, meaning magic. What do you mean? What would it be like if financial services had its mojo back?
Yeah, I mean, I think I was really pleased that you chose that, or you suggested that title, Michael, because one of the things we're trying to get across is that the economy and society cannot function without a successful financial sector. As I say, this is not about trying to destroy the city or bring it down. This is about making the city work better for ordinary people. And as I say, the economy just cannot function. It is a critical part of the economy. It makes the economy tick. But I think over the years, what's happened is that the City of London and the wider financial sector in general has almost lost a lot of its relevance for ordinary households and for the real economy. And just to give you a few examples, people will know that I worked on, campaigns around mis-selling, for example. We now have, at the last count, something like £70 billion worth of mis-selling scandals, £70 billion worth of redress that has been paid out because of mis-selling. So there's been a litany of those scandals that have left a legacy of mistrust. And I had thought that the days of multi-billion-pound mis-selling scandals were a thing of the past, but they're not. We've seen recently with the notorious defined benefit transfer mis-selling scandal. By our estimates, that could run up to about £8 billion actually by the time it's finished. And it is really disappointing to see that those large-scale scandals are not yet driven from the market. So I think the first thing to get its mojo back, I think the industry really has to demonstrate that it is trustworthy and that people can have confidence in the market, because without that, everything else is kind of second order. I think the second thing, I think, the industry itself is going to have to demonstrate that it can provide value to ordinary savers and ordinary investors and pension scheme members. And this quite sort of rankles with me actually, because, if you look at the asset management industry, which is heralded as one of these great successes of the UK, it generates huge revenues on the back of rising markets. It doesn't generate revenues on the back of showing skill. It just generates revenue on the back of rising markets. And a lot of that time it spends extracting value from people's savings. So again, the industry, if it wants to get its mojo back and be recognized as having its magic back, it is going to have to demonstrate that it provides real value for ordinary households. And the last point really I would make really is around, it is going to have to demonstrate that it is relevant to the rest of society. And I think that's the biggest challenge that the financial sector faces now, because over the years it has become associated with arcane financial products, arcane financial activities, and Canary Wharf and all that. And I know that's separate to the stuff that we're talking about, but the activities and the more arcane parts of the financial system really has crowded out the relevance of ordinary financial services to the real economy and households. So let's try and demonstrate that the financial sector has real relevance, that offers real value, and that people can have trust and confidence in it, deserved trust and confidence in it.
Well, it's interesting. I wrote a piece for our pamphleteers blog late last year about how PPI saved the nation. And my comment was broadly that the quantitative easing implicit in PPI was something like £1,400 per British household, which was quite telling. And I don't think people grasp the scale of it's not just fines; those were the payments and things. It's enormous.
I would also point out that other people have pointed out that the amount of money paid out in redress was almost precisely equivalent to the amount of capital our banks had to raise after the 2008 crisis. So, if they hadn't done that, then even with the crisis, they wouldn't have had to raise capital. We would have had better lending after the crisis and so on. So I think it's really important for people to recognize that the mis-selling doesn't just affect the people who have been missold. It affects the functioning of the lending system itself. Much wider externality costs to that.
Now, we've got a lot of questions and comments popping through. So, well, that's great. But I just on this slide, I was deliberately picked out the Cruikshank report of 2000, which was, in my opinion, a great missed opportunity. It was talking about restructuring the banking sector to generate more competition. And in fact, I also picked up this paper, Leviathan at Large. I'm an odd one. I'm a big fan of Andrew Tyree and Martin McIlway's work there, where I think they pointed out that the then proposed FSA of 1997 was lacking a competition remit. But there is positive news, isn't there? I mean, we've seen quite interestingly the new FCA chief making some pretty bold statements. Was it yesterday about how he didn't, the day before yesterday, how he didn't care about being liked, and was potentially, despite his background, going to pursue a reform agenda. And we've also seen, prior to his arrival, of course, the FCA taking this test case against state insurers. And in a sense, it's not that they're taking it against them. They're using this test case to try and speed up the process of which way the decision could go. At least that's how I read it. How do you feel about some of this?
Yeah, it was very interesting, wasn't it? I mean, I would definitely advise anybody who's watching or listening in to go back and look at the interview that Nikhil Rahid has just recently done with the Treasury Select Committee. You know, we don't have formal approval hearings in the UK, but that, you know, but the Treasury Committee is more or less playing that proxy role now of approving senior appointments. And I think what he said is the incoming CEO of the FCA was incredibly interesting, actually. You know, and I don't want to indulge in too much sort of Kremlin watching here. You know, there's always a danger of over-interpreting what forthcoming CEOs say. You know, but he said some incredibly interesting things about the role of the FCA in looking after vulnerable consumers. He made a very strong point about diversity in the financial sector, and he made it quite clear that, you know, this is no longer just a sort of a second order thought. This will become central to his thinking, the whole issue of diversity in this sector, which is, I think, is a very, very strong statement actually to make up front, you know. And he's also made a very interesting comment, which I thought that he very pointedly refused to support the idea that the FCA should have a competitiveness objective. And I think a lot of people on my side of the fence were sort of slightly worried that that because of post-Brexit and the role that the City of London is expected to play in the international financial sector and the role it's expected to play in the UK economy, we were concerned that the FCA would be given a competitiveness objective, you know, because for us, that's almost code for deregulation to attract more hot money from around the globe, you know. So I was reassured that he came out strongly against that.
Well, let's Mick, we put three. They're not exactly formal polls, but they're more sort of temperature testers. And I'm launching one now, folks. So we would use the facility. The question that Mick and I wanted to ask you is, how economically and socially useful do you think the financial services industry is? That is, how well does it meet the needs of households, the real economy, and policy objectives such as greening the economy? It's really just a temperature check. It's one of those sort of awkward questions. Just see people answering it. That's great. Almost everyone has voted at the moment. Okay. All right. Just give it one more second there, Mick. Good. I'm now going to close the poll and share the results. And there we go. Oh, interesting. A fairly split audience here. 50%. Probably how I feel. It does okay, but could do a lot better. Depends on the sector. Fair comment. It does a poor job, about a fifth of the audience, and it does a good job, 4%. So it's definitely not a star pupil, is it? So let me just try and get my slides back, which always causes me a bit of difficulty here. There we go. Okay.
That's a very interesting set of responses. Actually, quite balanced, actually. Yeah.
So we had four areas to cut through, and I've got a number of questions here. So the first one we wanted to look at was about treating customers fairly. Got a few comments here. John Hunter says the FCA has proved itself incompetent in basic consumer protection in its reaction to the pension transfer scandals, and now the same game in equity release mortgages. Do we need a regulator with a single objective of consumer protection? That's an interesting
that's a great question. Great question.
Yeah. Got a question here from Bob, a comment from Bob McDowell. I question whether the regulator is any longer an independent regulator, rather playing to the prevailing political thought and agenda. So some things there. Bob continues. He wonders if your agenda is a bit left-wing, more costs and shareholder tyranny. So some interesting points there. I'll pause there for a minute. Well, actually, maybe I'll take one more from Paul Nellis, who says, does Mick think we need to see actual criminal convictions to address the huge amount of mis-selling? So there's some comments for you to react to, Mick.
Yeah, I think fantastic questions. I think the first one about whether or not the FCA has done a good job. Look, I'll tell you what, my view on this is slightly nuanced. If I put it like this, look, I think compared to the old FSA days, the Financial Services Authority days, I think the FCA has actually made significant improvements in the financial services industry. I think it's unanswerable that there has been significant improvements in conduct of business, what we call conduct of business regulation in the UK. Over the years, the FCA took on a more consumer-focused agenda. It really did, and that is indisputable. However, I think the point about the defined benefit transfer scheme is a very, very valid one, because I used to chair the FCA's external risk and strategy committee while I was on the board, and the job of that committee is to try and identify potential risks to the FCA's statutory objectives. And if you remember some of my introductory comments, I said I thought that the FCA was wrongly blamed sometimes for failing to respond to scandals when it was actually the fault of legislation rather than the regulatory approach. I do have to say, when it comes to the defined benefit mis-selling scandal, the blame is largely on the FCA for that one. I think a lot of people saw that coming. There's a principle of follow the money. There was still the old contingent charging commission model in place. So that kind of combination of large pools of money, a conflict of interest through the remuneration arrangement, that was a flashing red light that was a scandal waiting to happen. So I'm afraid, I think on that one, I think the FCA really does deserve justified criticism for that one. But overall, I think it's actually done a reasonable job in actually driving up conduct of business standards in the financial services industry. The point about the single objective is an incredibly interesting one, because if you think about the number of roles that regulators have, what we call the regulatory family, as you've got the Bank of England, you've got the PRA, you've got the FCA, they all have different objectives. People like me are actually arguing for additional objectives around financial inclusion, for example. There are green campaigners who are arguing that the Bank of England and the PRA should have more explicit green objectives. So there's a range of economic and social policy objectives that must be delivered. And it's a question of how do you organise the regulatory system in the appropriate way to share out those objectives. If the FCA had a single consumer protection objective, then I'm afraid you'd have to create another regulator to actually deal with the market's objectives and the systemic risk objectives and so on. So I think it's a question of is how do you organise the system in the most effective way to actually achieve those objectives. That's the sort of the art and science of the regulatory architecture, as it were.
We like to think we get regulation right, but in a way we have so many different models, ranging from Ofgem and Ofwat, et cetera. And Shan Turnbull makes an excruciatingly good point. I was going to bring this up at the end, but I'll bring it up now. In regards to a new model of regulation that you're looking at, does this meet? How is this consistent with system science? It states you cannot control complexity directly, only indirectly from the bottom up with a requisite variety of supplementary co-regulators. And having done systems theory in my PhD, it's often referred to as Ashby's law of requisite variety. So it's not necessarily a bad thing to have competition amongst regulators. And when we created the unitary authority, which swept away the old SROs, which had to have problems of their own, but I was broadly more of a fan of that type of mutual regulation personally. But we then created this, the Leviathan that Andrew Tyree refers to. But let's take another little sounding from the audience, and we're going to move on to some of the opportunities in adversity. So you referred, Mick, in your proposal, you've got a lot of COVID recovery proposals that we ought to touch on. So I'm just going to launch a little poll here as well to get, again, the kind of the audience temperature. So if you wouldn't mind just stating how you feel, folks. What are the prospects for the UK financial services industry post COVID-19 and Brexit? Thrive, damaged, depends on the sector. Don't know, too early to say. Great, getting quite a bit. Oh, wow. I tell you, Mick, it's like training people on video games. They're extremely fast off the mark. So I'm going to close that one there with the bulk of the audience having answered. And I'm going to share the results. And it's basically
Wow.
basically 50% think it. Sorry, 46% think it will be damaged. 25% depends on the sector. Probably where I would fit, actually. 11% thrive, and 20% don't know, which are quite possibly the honest people. So well done them. Good. Well, let's just move on to sort of a second subject area you and I thought we'd like to cover, which was this COVID-19. And there's so much out there at the moment. We're seeing almost a complete ripping up of any type of game playbook that's been there. I mean, furlough in particular. When we were chatting, I pointed out I wonder if the United States has got furlough right in a way that we haven't, in the sense that what they're doing is giving direct payments to people. But they're removing those, I understand, at the end of this month. We furloughed people, so it's almost a crisscross where in the United States they tend to tie health to employment, which causes a lot of perversity. Here we give health directly. Now we're tying subsistence payments to employment, and the US is giving it directly. And possibly we're seeing a lot of numbers out of America where the rate of change in terms of people looking at their future employment, what they can do, they're taking action now to try and see where they get to, whereas a lot of ours is kind of wait and see. Anyway, Nick, your comments on this COVID-19 opportunity.
Yeah, I mean, I think it's one of those things where it's a threat and an opportunity, you know, as you can imagine, Michael, you know, because I do think this economic crisis has the potential for being worse than the 2008 crisis, you know, for a number of reasons, really. I think in 2008, you know, I started on the FSA board shortly after the crisis, just before we walked into the Eurozone crisis very shortly after, you know. So it was an interesting time, but you could see that crisis playing itself out in a clear sequence. You know, there was a crisis in the financial markets, became an economic crisis, and then we had austerity, which caused a public sector social policy crisis, and that kind of made it more manageable in a sense. You know, I mean, you could actually manage the recovery in a better way. This time around, we're seeing financial crisis, an economic crisis, a health crisis, a social policy crisis, a public sector crisis, all happening at the same time, you know, and an absolutely compounding effect with the like of I don't think we've ever seen before outside of wartime. So I think, you know, what concerns me really is that we have not given that much thought to what a recovery looks like. You know, I don't mean jobs recovery, but I mean in terms of access to financial services, access to credit, access to banking, access to insurance. You know, I'd say, you know, if you look at some of the surveys that are coming out from the manufacturing trade bodies, 43% of manufacturing companies now plan to make redundancies in the next couple of months. You know, this is going to be incredibly serious. So I'm slightly concerned that we've not really given any significant thought to the recovery here. At the same time, while that's a clear risk, you know, I think it's also an opportunity for the financial services industry, ironically, because the sector has a great opportunity to show that it can contribute to a shared plan for actually helping to rebuild people's financial services. You know, a particular issue is going to be around access to credit and credit scoring, for example. You know, the industry has a great opportunity to show that it recognises that that someone's inability to pay their mortgage isn't because they're feckless or whatever. It's because they were hit by this bolt from the blue called COVID-19, and it wasn't their fault that they couldn't pay their mortgage. You know, so I think the industry there has a great opportunity to show that it is socially responsible and it actually has a role to play in helping rebuilding finances in the post-COVID world.
Yeah. I mean, City UK published last week a response from the financial services industry about how it could help the recovery. Some of that was directed at some of the comments here about lending, but I think in many ways financial inclusion is equally interesting. And now that we have a much more pervasive government, which with a third of the workforce effectively on the government payroll as a combination of furlough or unemployment, it's interesting. And Shannon makes a point here: if you're seeking financial inclusion, why not follow the Australian model, where the government provides to every resident 14 years or over an internet-operated free bank account to obtain welfare payments and/or pay tax and other payments, a free debit card, and a free smartphone app to top up the debit card and make payments. It also means there's no need for your central bank to create a digital currency, which is an interesting point as well. But I think that takes us into other fields that I don't want to touch on today. It's interesting as well that on our previous discussion, there's a comment here from John Hunter that you can't have a single regulator for the buyer and the seller, the consumer and the supplier. You always need to, because of regulatory capture. So, John, you and I think alike anyway. So that's there. But the comment we wanted here, Mick, was your thoughts on the role of government going forward. I mean, government is just, it's leapt in. It's like a giant elephant in a tiny puddle that's kind of put its wellies on and splashed in to the financial services markets, and hasn't really actually used financial services to address the problem other than to use the payment system. Where do you see this going forward?
Yeah, I mean, I think it's interesting, Michael. Is it all, everything depends on politics, doesn't it? It depends on the political philosophy that is prevalent at the time. I don't know how this government is going to respond, but thinking logically, and I mean this logically because I think it was Sherlock Holmes which sort of says, once you rule out the impossible, what's left? You're provided with the answer, aren't you? You're left with the answer, and it's like I look at it like this. I cannot see how commercial financial services can actually provide reasonably priced financial products to people who are underserved or hard to reach or who are on low incomes. We have tried that for the past, ever since I was a campaigner anyway, we have tried and tried and tried to encourage market-based solutions. And the market has actually just singularly failed to provide financial services for financially excluded households. So I think I would say to my fellow consumer campaigners, I say to regulators, I say to government, look, the sooner we recognise that reality, the sooner we'll make progress on financial inclusion. And therefore, that means, as I say, I don't want the state to have a bigger role, but I'm just saying that there is no other option for the state to have a bigger role in promoting financial inclusion. And as I mentioned there, the one area where we have seen progress in financial inclusion is on access to basic bank accounts. That's because the government strong-armed the industry into providing those accounts with the threat of legislation in the background. So there's a number of ways you can do that. So I think it's almost inevitable that the state will play a bigger role if the government is serious about financial inclusion.
I think you're right. The bank accounts. Anthony Mojo wonders if the bank should be doing more about raising awareness of these basic bank accounts. There still seems to be a growing number of expensive tech-driven solutions designed to meet a problem that BBA legislation has already addressed. And I personally wonder, it's a million out of 65. It's that last, those last few inches to the tape. And couldn't we use things like the way payments are distributed to force that towards the Australian model?
I mean, it's interesting, Michael. Sean had mentioned the Australian model, and if you look at our paper, the paper we published in response to COVID, which is called Extraordinary Times Need Extraordinary Measures, we do point out quite clearly in the paper that actually the one institution that has actually performed very well during the COVID crisis is the state. Ironically enough, they've actually done pretty well in terms of, even the notorious Department for Work and Pensions, which has a terrible reputation for treating the poorest people appallingly. They've actually done a pretty good job, actually. And it's a very good, and the reason why the logic of having the state play a bigger role in inclusion is very, very simple. The state is the only agency that actually already has an established administrative relationship with hard to reach groups. And anybody who understands financial exclusion, anybody who understands why it's very hard to serve hard to reach groups, the biggest barrier to inclusion, the biggest barrier to the industry serving those groups is the administrative and distribution costs involved in reaching those hard to serve groups. Consumer credit's a good example. Whenever we had the sky high interest rates on payday loans, the bulk of those high rates were not down to risk assessment. It was actually down to the cost of reaching those hard to reach groups. So you have to find an organisation or an agency that already has an established relationship with hard to serve groups, and that organisation in this country is the state. And as I said, it is the one organisation that has come out actually pretty well during the COVID crisis. So yeah, we would like to see, it's inevitable that if we want to tackle financial inclusion, we've got to accept the market can't provide. We've got to accept that non-profit organisations like credit unions and others will only ever have a tiny impact on financial inclusion. Therefore, logic dictates that if we're serious about financial inclusion, there has to be a bigger role for the state. In whatever form that takes, there's a number of forms that can take, by universal service obligations, by using this administrative capacities, or it can mandate, mutuality, it can mandate cross subsidies, but there's a number of forms it can take.
Well, I have an open market bias, but I've got to admit, looking at the past 20 years, and a number of people say, look at challenger banks. And I think the comment we both made yesterday was something along the lines of, if you straight line the challenger banks, we'll have warp speed before any of them are actually putting any of the major banks into trouble. So a few comments here.
The big six banks now have a bigger share of the mortgage market after the financial crisis than they did before the financial crisis. So it's
and here we go. A couple of comments just to get you a flavor here. Amber Duffy agreeing with you. The FCA has moved forward in leaps and bounds, and the move towards thematic work around vulnerability has been significant, which I think that's a very positive point. Lloyd Greenside makes a comment I very much sympathize with. The old Rule 1.1 of the SFA was to be a fit and proper person, and that implicitly had an understanding of the person's moral and ethical behavior. What we see now is firms with a reliance on ever-increasing complexity of legislation, just focusing on the legality of their actions and ignoring their ethically correct responsibilities. And personally, I think, again, that comes from a less of a mutual structure. People in the financial sector don't feel that they have an obligation to make the sector itself safe. Some interesting work by, I think it's Romana and Ruffman or whatever over at Harvard, where they're looking at the ethical obligation of managers to open markets. And we seem to have lost that. That was the one thing I liked in the old SRO model myself personally. And finally, I'm just going to take something from Cliff Moyes, who quite rightly points out that really one of the bigger changes since 2008 has been that we've seen a move where banks really don't want, frankly, to be lending to small businesses, et cetera. And so they've moved into mortgages, property, insurance of various forms. So we've seen that reluctance again, also with the business interruption schemes, which I don't want to go into because we've had a bit on that already the last week. But any ideas on, in your financial inclusion, do you consider the issue of small businesses? You could consider individuals.
Yeah, we do, Michael. Actually, I mean, we don't really have a mandate to look at small business particularly, but I have to say that by definition, because we know from experience and from research that a lot of sole traders, for example, and a lot of very small businesses will actually finance their business through their personal finances. So we do pick up on a lot of small business through that. Anyway, I'm also, I used to chair the European Commission's Financial Services User Group, and I'm still on that until the transition period ends, until the Brits are thrown out of Brussels, But that group looks at retail consumers and SMEs as well, because we do recognise that SMEs and sole traders have the same characteristics really as ordinary sort of retail consumers. So a lot of the same problems apply in terms of access to finance, being victims of mis-selling, but also basically just finding the financial sector too complex and onerous to engage with properly.
Mm. Well, we're going to run out of time, but I'd like to take a few. I mean, you and I were going to chat briefly as well about, I think the financial sector has got an opportunity to get its mojo back on some of the stuff you said at the very beginning about social purpose. And it may be slightly a poster child when we look at UK consumer financial inclusion, but to shine on COP26 is another opportunity. And some of the moves that the Bank of England is thinking about towards central bank digital currency might go there. But we do have a few comments here. So I'll just read them out. Stephen Murgatroyd, in terms of basic banking accounts, can you comment on the move towards a cashless society that COVID-19 has accelerated? Sweden is now expressing regrets at the speed they moved. Interesting comment from Ian in West London. Basic bank accounts don't deliver financial inclusion in a practical sense, in my view. I'm with Shan on this one. I've been doing a lot of practical COVID-19 volunteering. The most vulnerable people often lack access to their own money in a format that enables volunteers to help them, which I think is fair enough. Bob McDowell is out there teasing both of us, I think quite right. For those who cannot wish or do not wish to manage their own affairs, perhaps they should hand them over to the state for better or for worse. And would it be better to structure a segment of the financial services sector as a charity to meet the inclusion of the social purpose? But I think you answered that one by saying probably not. So a lot out there, I think. And an interesting comment as well from Hugh Purser, who points out that power and communication are some of the big issues. It's a highly concentrated power in the financial services industry and highly diluted power on the consumer. Does the average pensioner know how their pension fund is invested? Widespread communication verging on education might help greatly, just as corporates are required to report on the markets and major investors. I have my own thoughts on that, Hugh. Noble, but it's not worked in my opinion. But Mick, those are some of the flavors there. Do you want to just come back on how these fit with what you're trying to achieve in the financial inclusion sector?
Absolutely, Mike. I think on the issue of basic bank accounts, I think people have made absolutely valid points. Look, I'm not saying that basic bank accounts are perfect. They could have been better, but it's undoubted that there was progress made there. In terms of reducing the numbers of people who didn't have access even to a basic functioning bank account. But yes, they could be improved, and we know from research and experience as well that some of the individual banks are not really pulling their weight on basic bank accounts. So there's certainly more to be done on that particular field. On the access to cash thing, that is still very important. And I completely understand that sort of a lot of people wish we would move towards a pure tech financial sector. Everything's done through digital finance and so on. But there's no question about it. Access to cash will remain incredibly important for a sizable minority of households. And what we've said on that one really is that I'm sure people will know, but the FCA as part of its regulatory structure has the payments systems regulator, and so what we've called for there really is for the payment systems regulator to actually ensure that there is sufficient access to cash in vulnerable areas, unless and until it is actually demonstrably true that technology is now neutral in terms of access. So think about it in terms of almost like I hate to use the word like a backstop, but we're basically saying that there should be a backstop access to cash in vulnerable areas until a point of time comes where it is clear that digital finance is as accessible to those groups as access to cash is. So that's how we would deal with that particular problem.
Mick, I'm sorry, I'm already getting the comments in. Do thank Mick for a fascinating and thought-provoking discussion, which is always a big hint to me that we've run to the end of time, sadly. But we did have a little poll that we wanted to launch here, just to kind of get a flavor of how people felt towards the end of this conversation. How will the industry be regulated post-Brexit and COVID-19? So tougher, less intrusive, depends on the sector, or don't know and too early to say. And I cannot believe how fast people are off the mark. This is great stuff, folks. maybe we'll have more polls and get the temperature of the audience. And I'm just about to close the poll. That's great. Almost everyone's voted. Great. Just going to close that and share it. And I think if our audience is a reasonable sample of people in the sector, nearly 40% are expecting tougher regulation. So that's an intriguing bit, but it's also intriguing to me that a fifth think it might have less intrusive regulation.
That's interesting.
Yeah, Mick, just a quick question before we close, and really, the state's been relying on global financial confidence. Any thoughts on how long that might last?
Do you mean in terms of borrowing, Michael? Yeah, interesting. I think it's a really, really big point. One of the things we've also said in our paper is that it is economically illogical for the state not to be borrowing to the max to fund, social infrastructure in a post-Brexit or post-COVID, post-Brexit world. I mean, I just don't buy this argument that actually, that the UK can borrow more money on the financial markets because, the bond. You remember the mythical bond vigilantes. I just don't think the UK is under threat to that extent. We still have the advantage of a very, very favourable maturity profile in terms of our government borrowing. Some of the short-term gilts are now down to negative yields, and it just seems to me to make complete sense to try and finance some of our important critical social infrastructure by using gilts. I think someone mentioned financial education there earlier on.
Thank you.
Right, Michael, that all these financial education initiatives have actually had very little impact on individual behaviour. But I tell you, the one area where I think there is financial education needed is about the state of public finances, because people in this country are brought up with the myth that government borrowing is bad. They need to be informed that on the other side of government borrowing is a saver and investor. There are people who will read the press who believe that government borrowing is bad when they'll have national savings and investment accounts and national savings and investment certificates. Mm-hmm. That is government borrowing, but they see that as a form of saving and investing. They don't see it as a bad thing. So I think if there is an educated process, and I really do think we need to educate the public that actually our public debt is entirely manageable. We have very low public debt ratios now compared to the post-Second World War era, when we still managed to achieve the NHS, the welfare state, the rollout of education. We actually faced those big public policy challenges and we didn't run away from them. We can do the same now in the post-COVID era.
Yeah, I think this is going to be a discussion that runs and runs. And whilst I agree with you completely on that point, the next point I turn to is this abuse of the word invest that the government uses. Because those monies that are borrowed need to be used wisely to generate the returns. Otherwise, it's not a national saving.
I agree, Michael. Look, as I say, I mentioned before, I think that there's 20 trillion pounds worth of assets. In the financial sector, those resources have to be productively used. The same principle has to apply to government spending as well. The spending must be productively used. All I'm saying that is it is a particularly low cost way of financing social infrastructure at the moment, and we should be taking advantage of that low financing cost.
Okay. Well, I can see from some of the comments that this conversation could run, because not everybody's in agreement. But everybody is in agreement on one thing, and that's how enjoyable it's been to have you here. If you give me just a second, Mick, I'd like to, again, thank our sponsors. Many of them are, as you'll see here, involved in financial services or the technology and payment systems and other systems that support it. And so allowing us to have a friendly critic like you along to share your thoughts, which I think we'd all actually agree with, the objective of financial inclusion is really super. The other thing I'd like to do is to thank you, the audience. I would point out that we've got a very interesting week ahead next week. We're going to be looking at financial forecasting, building a global Britain. What is this global Britain moniker? What does it mean? Does it have teeth, or is it just a government phrase? It's going to be very, very fascinating. We've got Madeline Moon on that. And then very much Mick raised the issue of pensions, and I know many of us, hopefully all of us, are interested in pensions. We've got David Pitt Watson on looking at what real reform would be. And finally, and something I wish we'd had more time today. I just wish we had more time with you, Mick. But Resilience Re, and Julian Enowizi is going to be looking at how do we insure the nation long term against the breadth of risks. And I'm sure he'll be touching on some of the financial inclusion issues in that as well. So it falls to me, I'm afraid, Mick, to, unfortunately, in these days of COVID-19, I am the one who has to thank you. I can't open up and show the applause, but I have a little Buddhist applausometer here, my karmic clapper. So I will thank you on behalf of the audience. Thank you so much for coming today. It's really been a delight having you. And we want to have you back so that we can see that there's progress moving on this. But for now, it's a goodbye to you, Mick, and goodbye to one and all.
Thank you very much. Thanks, Michael. It's been a pleasure. Thank you.
Likewise. Good.